more complexity, and with it, more room for error. So in my opinion, the best thing you can do is skip all those extra layers entirely and go straight to the underlying thing, which is the market mechanics, because that's the data that's driving all the reactions. And that's all you're trying to find via those other strategies. But by using the other strategies, you're just adding a layer of unnecessary complexity to it, right? So, and a big part of market mechanics is obviously Greeks, especially gamma. We don't have time today to go through every single last one because we would be here literally for hours, right? But we're going to talk primarily about gamma. Gamma positioning often defines those kind of gravity points in the market where price is likely to slow, reverse, or accelerate. So by going straight to the underlying data, you're not kind of guessing where those levels are based on an overlay or secondary method. Instead, you're going straight to the actual core data and you're seeing the actual positioning. It's just a cleaner, more direct, and therefore more accurate way of getting to those levels that you need, okay? So I'm going to talk primarily about gamma now. I'm not going to go into loads of detail about like what gamma is and how it works. We've written up so much information about this in the resources section on the Discord, and you can go and have a look at that if you want to. But effectively, you have either positive gamma and negative gamma. Very simple, okay? And when we look at charts, so when we look at things like this, which is the GEX charts, this one's particular is for Amazon. This chart basically tells us where there's areas of positive gamma, where there's areas of negative gamma, okay? Now, in areas of positive gamma, market makers will hedge against the movement of the price. So if you are in a positive gamma environment, if you are, say, on Amazon around this 220 strike, this 225 strike, both areas of big positive gamma, in this area, it's going to be a little bit more sticky because market makers, for every dollar of movement on the underlying, they are going to be hedging against that price movement. In the areas of negative gamma, the opposite thing happens, and market makers will hedge with price movement, which can cause slippage or fast movement through certain areas, okay? Now, you most commonly see me share this via these charts from Options Depth. I'm going to cover this briefly. This is from today. It was a really nice day, actually. Now, on these charts, areas of blue are positive, the areas of red are negative. So when we enter into an area of, in this case, let's say this big area of negative gamma, market makers are going to hedge in the direction of the price, which is going to force price to move more quickly. This is exactly what we saw this morning, very, very quickly. Once we failed, there was a big key level up here. There was a big test at, what's this level, 6475 to 6480. I think they've closed now. Oh, someone's reopened these. Interesting. Market makers were net short in this area, and it was a big test. If we fail to cross above this with any kind of force, we're within this negative gamma environment, we're going to start to move down. We're going to push away from this big test area. When we push away from this big test area, in negative gamma, it's going to move quickly. And that's exactly what happened. I think, was this on 5 minutes? Up here, you see how quickly we pushed away from that 75.80 strike all the way down, very, very, very quickly, all the way through this negative gamma. Where's my thing gone? Until we hit the area where it flips from negative gamma to positive gamma. Now that flip zone is very important because during the whole of this downturn, market makers are hedging with the price. It's forcing it lower, it's forcing it lower, it's forcing it lower until we hit the flip zone. And then the hedging also flips in this zone, which causes price to stall or chop in that area. which is then exactly what happened. You can see it almost perfectly followed the flip zone for all the rest of the day, right up until the end of the day when really charm starts to kick in, but we'll talk about that separately. So this is why I say this morning, and this morning's profile was very, very easy to understand what was going to happen today. It was very, very obvious. If we failed that test up at 75.80, it was very, very obvious that we were going to retrace back down to around 64.50, give or take, because of all of this negative gamma. And you can use this same process to individual tickers as well. Now, the information that we get for individual tickers is slightly different in its form. The concept is still the same, negative gamma or positive gamma, but its form is slightly different. For SPX, and this is why I think SPX is the easiest thing to trade, right? This was like the easiest possible thing you could have traded today. It was very, very, very simple. Like we've just said, we failed the test. It was an obvious move back down, and it was obvious where we were going to get caught as well at that kind of 45 to 50 level. It was very, very easy. That's because we have access to this kind of information. For individual tickers, things look a little bit different. Individual tickers, you can use unusual whales, or you can use optioncharts.io. I prefer optioncharts.io because I think it's just a little bit better and more user-friendly, but it's going to give you the same information, so it doesn't really matter what you use. And the disadvantage of, I think, using this for individual tickers is obviously you don't get daily expiries. You only get weekly expiries, I believe. It's not something I tend to trade, to be honest. So it's harder to use this for intraday, but it's still going to show you where your main levels are. So you can see, so this is Amazon. You select the expiries that you're looking at. So let's say you wanted to look like 1 month out on Amazon because you were looking for a swing. Firstly, is the gamma profile bullish? Okay, we're seeing a lot more gamma exposure on the call side than we are on the put side. If you are, that's a good thing. It's a good thing if you wanted to buy calls anyway, I guess. But also, where have we got areas of big values, basically? So in this case, we can identify that there's quite a lot of support here at 220. And we know that because there's a lot of gamma at 220, right? So if price starts to retrace back down towards 220, as we head closer and closer and closer to that strike, the market makers are going to be hedging more and more and more to keep price around or above that strike, okay? Because it's positive gamma, so they're hedging like against that move downwards. They're not hedging with it. If this was a big area of negative gamma and they were hedging with it, we could very quickly slip through that strike and down to the next area of support. And then the same thing happens on the upside, but on the upside, you've got something interesting. Instead of it being an area of support, you're going to have an area of resistance. Okay, so here, for example, at 225, did we see this today? Yeah. Price moved up here 1, 2, 3 times today, but didn't break through it, okay? Very, very close, like 11 cents off this 225 strike, and it couldn't break through it. And it's for the exact same reason, okay? People, market makers, are hedging against the move into this range. So this is effectively range bound right now between these two strikes until either positioning changes or there's a catalyst to push it higher. But this is all just creating stickiness and resistance. So this would have made, knowing this, you could have played 2 things today, right? One of 2 things. You could have set an alert just shy of 225 and played a rejection, and you got that, not once, but twice. And that would have made for a nice little day trade. Maybe twice if you're feeling brave. The second thing you could have done is played some kind of spread. If we know that price is unlikely to move above this strike, especially intraday, because there's so much gamma up here, kind of keeping price stable, we can look at playing spreads to capitalize on that. Okay, so you could look at maybe intraday. Well, you're gonna have to pick something weekly, aren't you? Because it's not SPX. You could take like a call credit spread. Maybe for like the 227, 225, 227 strikes, just on the weekly, you're gonna have like relatively good risk to reward on that. You obviously like use your noggin a little bit. But you don't necessarily have to play straight calls and straight puts all the time. And this is the other thing I wanted to touch upon, but I want to talk about this completely separately on another stream as well, is utilizing different strategies for different things and for different purposes, right? Because right now, is it the best idea, or would it have been the best idea intraday to just have seen all the gamma up here and thought, okay, I'm going to play calls towards that strike? Possibly not, because if we know market makers are hedging price, okay, or they're hedging with price to try and keep price in and around that range, we know we're not going to get like huge amounts of explosive movement, and we're not likely to get explosive movement past that range, certainly like within the next 24 hours or so, right? So if you want to play something short term, it makes more sense to capitalize on the support or capitalize on the resistance, and you can tend to do that a little bit better with spreads than you can with just straight calls and puts. Actually did this earlier in the week with Walmart. This is where that Walmart trade came from originally, that I think Spunger's called out, but you guys took it differently to me. So I actually took I was just weekly on this, a weekly call fly, because at the time, positioning looked slightly different to this. There was a lot of gamma on this 105 strike and basically absolutely nothing else on the chain. This wasn't here at the time. And I sold mine at like 32%, which is quite good for a short-term trade. I'm going to take that. It's not terrible. But I was targeting this 105 strike, knowing that this 105 strike would be a little bit sticky, right? Price was kind of hovering between 103 and 105-ish for a little while. So I took a call fly. I think I had the 103, 105, and 107 strikes, because I didn't expect price to move above 105, right? So I don't want to just take 105 calls. That's not going to benefit me, because I don't actually think we're going to get above there in the short term, because as we move up towards this strike, again, head to move against the price. So price is going to be sticky into this area.
Does it work now? Can you hear me? Can you hear me now? Is it working? Right. So basically, if you're looking here, can you hear me?
Potentially to play like a put credit spread, maybe over the next week or two, go out to like end of August, right? This indicates to me there's little chance we see much downside past 100. So why would you buy 110? Nobody else has bought 110. Okay, hopefully this is helpful though. This to me indicates there's little chance that we see much downside below 100, and if we do, it's probably going to be brief. All right, so you could here play some kind of put credit spread. Just take like the 100, 101, or even like the 100 and 100.5, because we're unlikely to fall much below that. So that's a nice like safe trade that you could just play as a weekly. You're not necessarily betting on upside there. You're just betting that there's no downside, or no downside past 100. Does this make sense? Is this starting to like click a little bit. I haven't really been reading the chat. Can I read the chat for a second to see if there's any questions? What platform are we using? So this platform for the individual tickers, this is optioncharts.io. This is relatively affordable, in my opinion, and I understand affordability is different for everybody. This is, I believe, under $30 a month. For SPX intraday, this is options depth. This is the best thing I pay for by a long shot, but it's not cheap. I think it's around $230 a month. But obviously it's worth it. Like today, I think that put fly we had ran to like 200% or something. It was up like $600 or something like that. So it more than pays for itself. But I totally understand that like it might not be an affordable thing for everybody straight off the bat. I will continue to post updates from this in the Discord throughout the day over the next few weeks. You can also get this information from Unusual Whales. I don't tend to use it in there, if I'm honest. I don't mind Unusual Whales, but I don't even know why I still pay for it. I pay for it, and everybody else uses it more than me. Like, so many people have access to my account, and they all use it more than me. So I'm basically at this point just paying for other people to use it. Tomorrow, I don't think we have tomorrow's profile yet. Let me see. No, I don't have tomorrow's yet. We usually get... Oh, hang on, let me see if it's available. Okay, we do have something for tomorrow. The other thing to note here, and I noted this on the last stream that we did, is I don't know if many people know this, but with SPX, most 0-day option contracts are opened within the first 30 minutes of the market open, and that's both from customer side, institutional side, and from retail side as well. Most positions are opened within the first 30 minutes, and therefore the profile can update and change a lot within the first 30 minutes after market open. So I strongly recommend that if you are going to use this, look at it before market open, reassess it minimum 30 minutes after market open. Obviously, ideally have it open during the day and kind of monitor what's going on, because it can update quite a bit sometimes during the day as positions are opened and closed. I noticed a lot of 4:30 puts were open today and then closed intraday. That doesn't happen all that often, or certainly not from the institutional side. Most retail traders will close 0-day positions intraday. However, most institutional customers don't. Most institutional customers will open positions within the first 30 minutes if there's 0 DTE, and they leave them open then the whole day. And they also will very, very, very rarely do we see big orders come in of just straight naked calls and puts, especially on SPX and especially 0-day. They are nearly always spreads that make up iron condors, sometimes flies. They are very, very rarely just naked options. This is the profile as it stands for tomorrow. There's not a huge amount on here at the minute. Looks relatively supportive up until sort of this 480 range where gamma flips from positive to negative, which indicates right now that if we can push over this range or open over this range, we'll obviously again likely get hedging in the direction of price, which could see us move upwards very, very quickly. However, this is all very, very likely to change before tomorrow, as positions are opened and closed sort of within that first 30 minutes. So this also indicates, like, it's very unlikely tomorrow that we push above like 540. Same thing here. Yeah, see, at the minute, this looks like 540 is like the cap, absolute top cap for tomorrow. But this will just change so much that it's honestly probably not worth going over it right now. Okay, let me see what else other questions have we got. Oh, the challenge. Okay, so I did the first week of the challenge, and then we literally made $10 that week, and I was like, kind of gave up with it. I was like busy that week, and it just was a bit of a disaster. So, and then obviously I've gone on holiday. And by the way, I'm moving house next week. I get the keys on Tuesday, but I'm actually moving. Oh shit, did the man say Thursday or Friday? I really need to check that. I need to know what time I'm going to be moving house. But I'm moving house next week as well. So I am going to start the challenge officially next week. And I suppose it's worth noting here as well that trade that we had today, that put fly that we identified fairly early in the day, that's the perfect sort of trade that I'm looking for this challenge, because that trade, I got into that a little bit early. I will be the first to admit I was a little bit keen on clicking the buy button today. But if I had waited, there was a really good opportunity to get into that trade at like, I think it was about 1.4. And it ran to, I think, about $8 at its highest or something. It had really, really, really solid risk to reward on that trade. And that's the sort of trade I'm looking for, because when we take something like just a naked put option, for example, had we done that this morning, that would have worked, but it would have been more expensive to open in the first place, which means we're risking more of the account. And we also have to consider the theta decay that's going to eat into that position. So if we can find something that actually benefits from theta and is cheaper to enter in the first place and potentially has a better reward, giving us a better RR overall, that's the perfect trade for this kind of challenge account. So in the end, I think that trade ran like through maybe 300% or more or something. Obviously we wouldn't have let it run that long, but we could have got into that with like max risk of 5% of the account value, but got out of it with like more than 10% of our account value in profit, just off that one trade. So that's the sort of thing I'll be looking for. Questions. In this Walmart example, your spread would be 100, 105, and thinking that price will chill in that range, correct? Okay, so in the Walmart example, how I would play this is one of two ways, really. I would ideally look for like some kind of put credit spread. Put credit spread is basically a way of saying, I don't think price will fall below this value. It doesn't matter where price lands above that value, as long as it's above at the time of expiry, you will benefit 100%. So if you took, for example, what do we have available? What date is it today? The 13th. This is not a ticker I often trade. So if you took like the 101, 100 put credit spread, you've got not far off 1-to-1 risk to reward with that. But basically what you're effectively kind of betting on there is that come expiry on Friday or next week, whenever you want to take it for, you're betting that price will be over that 101, 100 range. Your break even specifically would be 100.58. But it doesn't matter if price is 101.1 or 130, you would get 100% profit on that trade. So it will tell you what the max profit is when you take it out, and the max loss, and the max profit. If it's above, in this case, 101 at the time of expiry, you would get the max profit. So it does cap the profit doing it in this way, because obviously if you just had a call, say you had an open call at like the 105 strike and it suddenly ran tomorrow to like 120, that option might go up, what, I don't know, but it's probably several 100%. This caps your max at 100%, but it's also capping your losses a lot better, and it's also just giving you a little bit more flexibility in terms of price movement, because we're again just kind of basically saying, well, we think price is going to be over 101, but we don't care if it's 101.1 or 102 or 104 or 105. We just don't really care. As long as it's above 101, then we win on that trade, so to speak. Yeah, literally so many people have my unusual Wales login. Does Gamma operate kind of like a magnet? This is a little bit of a misconception. So both yes and no. So if you take this Walmart one, for example, price is likely to be a little bit sticky or magnetic around these levels of high gamma, right? And that's because at the levels of highest gamma, that's where hedging is going to be kind of most, how do I explain this? Most flat, in the sense of when price, if everybody that's got market makers that have got contracts at that 100 strike, for example, they are completely delta neutral at that strike. So for them, just keeping it at that strike is beneficial. So that's, in a sense, it can be a little bit magnetic or sticky around those areas, right? Then it's same thing on the upside. If we were to shoot to like 104.8 tomorrow, we're likely to gravitate there, but then kind of either sit there a little bit stationarily, or we might even move down a little bit because of those hedging processes underneath. It's not necessarily, though, like right now we're at this just over this 100 strike. This 105 strike isn't pulling price up. This is also to do with delta. I don't want to make this stream too confusing, because I really don't want to like people to walk away from this and be like, I have absolutely no idea what the fuck she was on about for half an hour, and I'm so confused. Where you have areas of really high gamma, but the strikes have low delta, the gamma doesn't mean a lot. So it's basically you're so far away from the strike that the gamma is irrelevant, effectively. I don't know what the delta on this is right now. I have absolutely no idea. But if the delta is relatively low, then that gamma is effectively just irrelevant at this point. But obviously, gamma at this 100 strike is going to be relevant, because the delta is going to be much, much, much higher based on where current spot price is. Does that make sense? Kind of ish. After 30 minutes, it isn't as likely to change. So going back to SPX, it does change a lot intraday. It does. So you do have to continue to monitor and come back to this consistently throughout the day, but it will change less after the first 30 minutes. The biggest changes to the market maker positioning and to gamma positioning and charm tend to happen within the first 30 minutes of the day. It's possible very, very large orders come in later on in the day. There were some big orders coming down here earlier today at this 4:30 strike. They weren't there this morning. This morning, this profile was very, 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 very heavily skewed on this side. Market makers were basically just net long everything apart from this 75 strike, and then it's evolved throughout the day. And you can see where we've got significant areas of interest. But yeah, this will look different now because this is how it was at close. What happens in those mixing zones? The neutral zones. So do you mean like here where there's basically just no values, or there's no gamma, where the values are so low? Yeah. Then there's more influence from other hedging processes, in particular. They can be areas where you just don't get as much hedging going on. Kind of like on these flip zones. It'll be around these flip zones where the areas are the lowest, and you often get price reject or stall in these areas. Very, very common. But you'll also see bigger effects from things like Charm, Vega, Vana. Again, I don't want to really overcomplicate this today. I'm happy to talk about it separately, but I think if I throw everything at you that you need to know now, people might cry and never talk to me again. So for now, focus on gamma, maybe Charm to an extent. Charm is important. Charm was very important today. But yeah, you have more influence from, say, Charm, where you've got very low or no gamma on the profile. And some days you have a profile that doesn't look like this. Some days you have a profile where there's just nothing. Well, there's nothing going on. And they're the hardest days to trade because other things in the underlying can have a bigger impact. I want to share my screen on and ask a question. What? Okay, NTB, I don't know what you're talking about. Please, what? On OBS? I don't know what that means. Okay, I'm gonna move on. I'm turning into TT. Me? How am I turning into TT? I'm confused. Yeah, NTB is gonna be living in a tent in my garden if you weren't aware. Could you possibly share the gamma for SPX before and after the first 30 minutes so we can see the difference and understand the 0DT callouts better? I will try my best to send it to you pre-market and then the Discord app from my phone because it was becoming problematic. So I only now have it on my computer, so I might not be online as much. We're gonna build a pizza from the garden and the tent. Yes, you're welcome to live in my shed. Oh, you finished your pond. That's lovely. I also do have a pond. That's very nice. How many trades did you take on the tent? That's not aimed at me. Okay. This stage is mostly helpful for guiding your bias rather than necessarily determining your specific entry points. No, I would say this is extremely important for identifying entry points, because this is effectively going to show you where price will reject or stall or bounce from. So 0DT on SPX, obviously here we rejected at that 75.80 net dealer short and also gamma flip zone as a result of that. So it was an obvious short there. But on individual tickers, this will basically tell you, I think did we look at Amazon or something a second ago? This will tell you where you can enter for short and long opportunities. So if we look like, so there's a lot of support for Amazon at 220. So I would set an alert at 220 or just go just above 220, go like why is my brain not functioning? Go like 220.2 or something. I was gonna say 219. No, that's not above 220, is it? Go like 220.2 or 220.5 or something like that. That's a potential area then for an intraday bounce. And then on the upside, you can do the opposite. And this happened today twice. We know that we're likely to see rejection at 225. So you can set an alert just before 225, so like 224.8 or something like that. And that would have actually given you two very nice intraday rejections that you could have played. Now, something to note on this though, check these charts regularly because they update, they change. These are based on the options chain. So as options get closed or opened, this is all going to change and update. It's not going to change too much intraday for these kinds of tickers, but it will change and update throughout the day. The more So you play the first rejection, take a stab at the second rejection. I would be hesitant to play the third rejection in the same day. I mean, this happened right at the end of the day, right? This was like literally the last candle. But I would be hesitant to play a third rejection in the same day. But you definitely could have played this one, and you definitely could have played this one. And then on the downside, if we get this 220 has already acted as support once. Was this yesterday? The 12th? Yeah, this was yesterday, right at market open. So that would have also given you opportunities to go long yesterday. But it does update regularly, so don't just like set a bunch of alerts and then like forget about them and then just trade off of them in like a month's time. It's not going to work like that. The other thing to note as well is on these charts, when you have tickers that are lower value, someone mentioned Sophie before. This is a stock I know nothing about, by the way. Like literally nothing. It's harder to use these on these tickers because the tickers are less in value generally. The strikes are closer. The strikes are no closer together, but you have a bigger percentage difference between the strikes. So for Sophie to go from 24 to 25, that's what, like a 3% difference? I don't know off the top of my head, honestly. I've been up since like 4 a.m. It's been a long day. But if a stock like Amazon went from one strike to the next strike, it's a much, much, much smaller percentage difference, right? So it's harder to use them for this, but you can still use it. It would just be near on impossible if you had stocks that were like trading at like $2 or something, because there's just going to be gamma at like every single strike. It's not really going to tell you anything. You want to know where price is supported, but obviously, like if you've got, I don't know, some that's trading at like $3 or something, if it shows support at $2, that's a long way down from 3 to 2 percentage wise. It's huge. But obviously on something like Amazon, from like 220 to 225, it's not as great a percentage. And you've got a much bigger kind of, I think you know what I'm saying, but it's hard to explain. If it doesn't make sense, tell me and I'll write it up and then maybe it'll make more sense. But yeah, it makes more sense to use this on tickers that trade at a higher kind of. Okay. Yeah, I'll share the gamma stuff in the chat as much as I can.
Can you hear me now? Does it work?
Yeah, it works.
Right. I did nothing, just closed the Discord and came back. Right, towards the end, I have some questions and I want to share my screen, but I can only share it if I close the OBS because I'm using it to stream. And
I don't know what OBS means.
Right, OBS is a software which lets me stream on YouTube. So it's basically recording my stream. Just put it
Okay,
there.
okay.
But I need to
Okay.
close that first so I can share my screen here. So
Okay, that's fine. Shall I carry on going through the questions in the chat? Because I think I've got behind. Do we always wait for after 30 minutes to make a decision on an intraday play? Not always. Sometimes the profile is really, really, really obvious right out the gate, like it was today. Other days it's really not, and it can evolve quite a lot. When you have a really obvious profile, then yes, you can just kind of trade it straight out the gate. Like this was just so obvious, but like if you look at tomorrow's just looks like a mess compared to today's. I know this will change a lot yet. But this is not as clear. This is nowhere near as clear. This to me indicates right now, if we open above 445, which we probably will, we likely just see a supportive move up until we get to this flip zone, and then it's anybody's guess as to what's going to happen. We either reject from here and we just grind all the way down, or at this level, probably actually into this 490 strike. But other days it's just really, really clear. I don't know if maybe there's an example. I mean, this up here is clear, but it's just not relevant right now because we're too far away from it. But let's just say for argument's sake, right? Just argument's sake, right out the gate tomorrow, we were at 6,510. We open up here. We're looking this part of the profile. This is charm. Let's, for argument's sake, say gamma looks very similar, and we've got supportive gamma below us, or in this region, we've got negative gamma above us, say. We just slowly drift through supportive charm and positive gamma all day until we get to this flip zone, and then we just land here at the end of the day. It's obvious what's going to happen. I mean, obviously, like one Mango Man tweet can change all of this. The same thing can happen if we just enter straight into negative gamma, suppressive charm. We start moving down. We're going to be hedging with the move because we're in negative gamma. We've got suppressive charm, and throughout the day, that's going to get stronger and stronger. And by the time we're over here, we're still in negative gamma, we're still in suppressive charm. We're just going to keep moving down until we land here. Right? And sometimes the profile is that obvious, and you don't have to wait for a decision on what you're going to do. But other days, it's not that obvious, and you do need to kind of sit down a little bit and wait. Blue line, gamma flip, 0 gamma. On here, this blue area is the area of highest gamma, and the green is the gamma peak. So that is the highest gamma. And then the red is negative gamma, with the yellow being the lowest value. So the gamma trough. What made us rally higher end of day today? I think, I don't think we can see it on here now. End of day today was a little bit unusual. I say it was unusual. It wasn't. We were in suppressive charm for a long time, but then we hit this pocket of supportive charm. And it was from here that we really started to make this move upwards. All of this here, I don't know if you can see it very well. This is all supportive. But we also had some positioning changes right at the end of the day. There were loads of 6,430, 6,425 and 6,420, I think, puts that were open on this positioning that were closed towards the end of the day, which altered the profile. So there's quite a bit going on towards the end of today. this is also updated a little bit since. We also had a little pocket here of supportive or positive gamma. So we had this mix of like around this 460 strike, we had supportive charm and positive gamma, and we had short positions closing below us that ultimately just pushed us higher into the end of the day. Can you say cup of tea? I guess there you go. Can you say with all due respect and good morning, governor? Yeah, but I don't say this how you expect me to say it because I'm not from London. So do we look? Wait, can you say what the hell is this? Gibbity toilet riz. I feel like that's offensive, and I don't know that it's offensive, and I've just said it. Do you look at put and call volume? That is basically what's influencing this. In a lot of ways. Certainly, so this here is telling us where dealers are net short and net long. Where dealers are net short, so here, for example, dealers are net short a lot of calls. That's because they have been sold to customers. If you change this to customer view instead of market maker view, you will see effectively the opposite. And this is reset because it's the end of the day. But you can see it from firm, professional customers, non-professional customers, and brokers. You may as well take non-professional customers off because they're basically retail and well, their opinion means jack shit. And also they don't hold like big weight in here. In terms of volume, but yeah, this is effectively what that's telling you. So where market makers are short calls or puts, that's because they've been sold to customers, and where they're long calls or puts, because they're on the other side of that. Does GX by OI and GX by volume have any deviation? They will be slightly different. I think by standard, yeah, it's set to open interest by standard, and I would always use open interest as standard. But if you change it to volume, it won't change all that much. You'll still get more or less the same information. So you see it's highest on the 24 strike. Is more or less highest on the 24 strike either way, but yeah, use open interest instead of volume. I've already said this. Okay, you sound like that, bro. What? Okay. Oh, you're on about TV. I can't multitask, you're correct. What do you expect me to say? Wiz Khalifa. Isn't Wiz Khalifa a rapper? Is that true? I feel like I've heard that somewhere. Shit, there's like 140 new messages in here. I'm never gonna be able to read all these. I'm just gonna look for the ones that are actually questions. If market makers are net puts, does that mean they are selling shares to hedge? Do you mean if they're net short or net long? Ask me that question again, but ask it properly. 60 seconds on charm, please. I don't see this on my trading platforms. You're not going to get a huge amount of information on charm, unfortunately. Intraday options depth obviously has it for SPX, but for individual tickers, you can get some information from Unusual Whales. It's just not great. It's not ideal. I will do a separate stream to talk about charm specifically, because we'll be here for hours otherwise. Volatile market. Volatility comes from negative gamma, basically, because market makers hedge with the movement of the price, which obviously causes price to move more erratically. And that's why it was so hard to trade. Do you remember a few months ago, obviously, when we had that big sell-off and there was all these tariff fears and all of that happened? That entire time we were in a negative, what we call negative gamma environment, and it made it much harder to trade because the market moves a lot more erratically. Had we started moving up with a lot of strength through this here, we could have very quickly moved back up again. But obviously it's more difficult to trade negative gamma environments than it is positive gamma ones, because in positive gamma price moves a lot more slowly, more likely to get stall and chop, etc. Okay. Charm doesn't show me shit. I think those charm values on so the thing on Unusual Whales, so Unusual Whales has Periscope, and Periscope via Unusual Whales is supposed to be like Unusual Whales' alternative to options depth, in that they're showing you market maker positioning, but it doesn't. It works fine. They're what do you call it? Not algorithm. Their modeling works fine, in my opinion. But the issue is that they show you everything in like little 10-minute time frames, and you have to go through like all of the time frames to look at where things are heading. So like here we can see that actually it had come 2 o'clock come around and we've been down here in this range. We have supportive charm in this area. On Unusual Whales, you have to click through like every single little 10-minute time frame to find that out, and it's just a bit of a fuck about. Kind of shows another example of where price would pin at a gamma strike. Did we not have this yesterday, or was it the day before? It was Monday or Tuesday. Wait, hang on. Where was it? We said, was it yesterday? Let me check. Yeah, so very close to market open yesterday, about an hour into open. We said 6,380, end of day pin looking increasingly likely. And we said that because I don't know if I can go back and access the charts. Can I do that? Hang on. Oh, now I've lost the stream. Oh, I'm so bad. Okay, no, I found it. Can we look at yesterday's? Ugh. This isn't yesterday. Oh, maybe it was Monday. I don't know what day it was. I forgot. Okay, no, it was Monday. See, it's hard to look back on this because it's evolved so much throughout the day. So I don't actually know what was going on here because this is now different. And we said 6,380 end of day pin. I can't remember how we got to that conclusion. I know it was right, but I can't remember how we got to that conclusion. The best person to ask might be Idrethal, because I was talking to her about it, but my brain has been fried since then. I don't remember how we... I think there was... Okay, apparently neither of us remember. I think there was a lot of net dealer longs in that area. So where you have big net dealer longs, these catch us on the way down. Now, again, bear in mind, this has all changed since. This is like right at the end of the day positioning. I don't know if I can get back far enough. But let's say we are trading. Let's say we're trading up here, right? 6,470 on this day. I don't care what day it is. It's irrelevant for the purpose of this explanation. And we start moving. We move up here and we reject it for 6,470, right? That's likely to happen because at 6,470, dealers are net long. They are hedging against the movement of the price. So when they get to 6470, they are delta neutral. They are going to flip their hedging strategies. They will start hedging away from price, which means that we're going to struggle to move. This price point becomes sticky, right? Say we do reject off here, and then suddenly, let's imagine these net shorts are a little bit bigger than they are because these values are very low, but let's imagine they're a bit bigger. We start moving down through these strikes then, because this is all representative, most likely, of negative gamma. We start moving through these. This catches us, and that's what happened today, right? We said today, fairly early on the downside, 6445 will catch us. And the reason for that was at the time, it was the biggest net dealer long on the profile. And the same thing would have happened here. Had we been up here, had we moved down, this would have most likely caught us on the way down. This tells you very specifically where we expect to see price bounce from or reject from, on the upside and the downside. And it also tells you where we expect price to stall, slow grind, and chop. We had this on Monday, Friday, I don't know when it was. Go back through all the commentary that I post in my channel that's supposed to be for call outs, but it's just kind of turned into me like ranting at people. And there's some good examples in there. We had loads of net dealer longs above us the other day. That just provides resistance on the way up. If we start to move into those, it's all positive gamma, we'll just grind up through those areas. I think this is what happened yesterday. Where's yesterday? What day is today? Wednesday, Tuesday. Where's Tuesday? What is this? Tuesday. Yeah, okay, yeah, this was exactly what happened yesterday. Someone asked me about this in DMs, I think. There was this like big test level. Can I draw one here for you? Between 6:15, 6415 and 6420, right? Over 6420, we just had so much positive gamma right above us, but we had a lot of support down here. We had supportive charm later in the day, but there was nothing to indicate that we were going to move up with any kind of explosive movement. All of that positive gamma means we just slow grind up throughout the day, and that's exactly what happened. Once we'd got over that flip zone from this negative gamma that caused this kind of choppy whiplash movement into this positive gamma environment, we had a huge, what someone called this a butt plug of dealer longs, which I just thought was really funny. But then also like I'm really childish and I find things like that really funny. There was a butt plug of dealer longs above us, and that caused some resistance, but also the positive gamma from those helps to basically just create this kind of choppy but slow grind up, because there's nothing to point us downwards, right? Yeah, there it is. You got the screenshot and stuff. Yeah, so there's nothing to point us downwards from there, but there was a lot to point us to just upwards chop throughout all the rest of the day with supportive charm, supportive gamma above us. I think that's what happened. Don't quote me on it because it was Monday and I've forgotten since then, but someone will correct me if I told them differently in DMs, but I'm fairly certain that's what happened. It's hard for me to go back and check this. Oh, it was Friday. Okay. Supportive charm. Yeah, if charm is supportive, this is what we saw today, but in reverse. If charm is supportive, it should just pull price up. But charm is less relevant at the start of the day. Charm is most relevant towards the end of the day because the values increase so much. So on your charm chart here, and this was really clear today, it was really nice. As soon as we broke here, this kind of 6, 6, 4, 6, 7 level, we flipped from being in supportive charm, which had we've held above that test zone, that 6475 to kind of 80 test zone, had we held above that, we probably would have just slow grind up all afternoon into this 6,500 strike, because gamma would have helped drag us up there, right? Because we would have been in negative gamma, which would have just pushed us into the flip zone at like 85. And then all of this supportive gamma, which is basically just slow grind, very boring, trap upwards. But we would have also had supportive charm, okay, which would have just dragged us up into this 6,500 strike. And you can see the values at the start of the day, like negative 38, negative 37. But towards the end of the day, these are like negative 400. Okay, so, and we would have just been dragged up that way, but we didn't. We failed that 75-80 test zone, right? Once we failed it, we started moving down. We start moving down through the negative gamma, right? And again, market makers are going to hedge into the price movement, or so with the price movement. So we're going to move down more quickly, which is exactly what happened. And we moved down into negative charm. So between then us being in this kind of crappy gamma flip zone, which we basically just followed throughout the rest of the day, and this negative charm, there was nothing to drag us upwards. There was nothing to really drag us too much further down, because we had these pockets below us, but there was nothing to drag us upwards. Not at least until right at the end of the day. When does it become most effective? When the values increase. So just literally look at the values. If the values are still like low, because sometimes like even on the charm profile, right, the values towards the end of the day are shit and they don't mean anything. So you need to look at the values, but like up here, look how suppressive this is. We were never closing above 6505. It wasn't going to happen. We would not have pushed up there easily through all this positive gamma. And then we would have also been fighting against charm, trying to push through positive gamma and negative charm, or suppressive charm, I should say, actually, just was never going to get us there. 6475 specifically because of this massive, I think it's gone from the profile now. This net dealer short was huge this morning, and it was by far the biggest strike on the board by a long shot. This looked completely different first thing this morning. It was very, very obvious test zone. Honestly, like this was like right out here, and everything else was like virtually non-existent. I don't know why somebody opened those, to be honest. They've closed quite a bit of them intraday, but yes, a customer has got open a lot of those 6475 calls. I don't know who it is. Sometimes you can tell like what institution it is, but I don't know who it is. Let's just show the zone. So is charm most relevant end of day because delta is changing so much, so hedging is more basically yes, the hedging is more aggressive. Because your options are losing value more quickly. Can we see it side by side with the net dealer calls and puts? Oh, that's not aimed at me. Okay. So why can't I take advantage of end of day charm for SPX? You can. You absolutely can. The best end of day plays that you can get from this information is going to be when everything aligns. And it's often quite easy to spot the end of day pin. So like today, we obviously played earlier in the day for this 445 level, which was hit beautifully. This was a big net dealer long. We bounced off there. From there, it was pretty obvious that we were going to pin 6460. And you could have taken like some kind of call fly or something. I would say like fairly late in the day, probably around here, like in the last 2 hours. You could have taken like a call fly to target that 6460 pin, and that would have been a a really nice play, really easy play as well. It's very obvious that's where we were going to pin. Is this? See, I can't like go back on this, which is so annoying. But yeah, we had big-ish dealer long at 6-4-60 come the end of the day. And we had some, it was the only area of positive gamma. And we also had supportive charm pocket that pushed us up into there as well. Why are they inversed? Why what inversed? The values on charm. This confuses everybody. No. Negative values on charm are supportive and positive values on charm are suppressive, but on gamma it's the opposite. The negative, well, it's not exactly the opposite because it's not exactly supportive suppressive, but negative gamma is going to cause more chop, and the negative gamma is going to cause dealers to hedge with the movement of the price, which causes the price to be a lot more volatile. But yeah, on charm, don't ask me why exactly, it's not easy to explain. But yeah, the positive values are suppressive and the negative values are supportive. I can't remember which color is which. Yeah, that's fair. Blue negative good, yellow positive. No. That's a good way to remember it, I guess. There is negative delta, right? Negative delta where? What? Why would you have negative delta? That doesn't make sense. Can delta be? No. Delta won't be negative. But you can have negative gamma, yes. Wait, what? How? A delta's either going to be like 0 or above. Negative dx. When the delta values are so low, if I've done a really bad job at explaining this. When delta values are low, the gamma that's associated to those strikes is no longer relevant because the delta is too low to have any relevancy for hedging towards like at those strikes. Is that what you mean? I'm confused now, but I have been talking for like an hour, so maybe that's why. I'm gonna let NTB take over and say what he wants to say and ask his questions. Because I need to take a break for a second before my brain explodes. Is he there? Hello? Okay. I don't know what that says.
Hear me now? Sorry. My mic was
Okay.
open.
Hello. Yes, we can hear you now.
Yeah, just give me 1 sec to get my headphones. Right, I need to stop the stream so I can share mine.